Ladies and gentlemen of the crypto space, we're live on a Monday, June 5th at 11:30 a.m. It's a hot day of news. Treasury is about to do a capital raise. CZ is under fire from the United States regulators. How is it for the other several hundred countries around the planet? Isn't that more interesting? News and thoughts about the likely pause? Should it be a pause? Does it really matter? Is the Fed in control at all? Domestic liquidity conditions aren't the most important thing to understand. It's overall systemic liquidity conditions. They're about to dump treasuries on the market, which is going to drive down bond market volatility. I will show you the chart. This is not just anecdotal or what's potentially going to occur. You're going to flood the market with what? Hundreds of billions of dollars, at least several hundred within a couple of days, a week, 2 weeks. And they're going to need to raise what? $1 trillion, $2, $3, $4 trillion between now and 2025. How could this chart not go down? And as Mike Howell talks about, when bond market volatility falls off a cliff, international dollar liability printing takes off. And that's when international markets are flooded with dollar liabilities, and that's the relative nature of the dollar printing press, because dollars outside of the U.S. are printed using U.S. government securities. Don't be too overwhelmed with domestic affairs. U.S. domestic affairs, CZ getting sued is a legal matter for him, the organization, domestically in the United States. What's the significance of that from a global perspective? Are you invested in a U.S. market? Or are you invested in an international market that's globally accessible directly from any country, place around the world, a remote desert island with a satellite connection? That's it. So in a world where, fine, a lot of people live in the United States, look, liquidity conditions are continuing to deteriorate, which is, if not already, significantly putting pressure on domestic U.S. credit conditions. I find it fascinating that when credit contracts, historically, you have bankruptcies. You have insolvency, where a company, I didn't even show you the chart. I didn't have the chart up. Sorry, guys. This is the move indicator. And they're going to issue the treasuries, and this falls off a cliff. And basically, technically speaking, it looks to be heading in that direction anyway, with the monthly breach of the TWAP inevitably to the downside, because all markets operate cyclically. They do not head in one direction or another for a continued period of time. There is cycles inevitably. So credit conditions in the U.S. are continuing to deteriorate, which typically leads to insolvencies and bankruptcies. This is where Luke Gromen's ideology comes in, and the change, what Raul would talk about, is the global reset in 2008, where you cannot afford for a mass wave of insolvency like what has occurred historically in financial markets, because that would be a recession. With a recession, you're going to have a decrease in GDP, and that probably plays into why the resolution to the debt ceiling was to be neutral. They weren't going to increase any spending at all, because what the hell, where's it going to come from in GDP land? If credit is contracting and we're going to have potentially insolvencies and unemployment increase, you're going to have reduced GDP, reduced treasury tax receipts, reduced productivity, and to some degree or another, monetary policy and fiscal policy is going to have to sustain the status quo such that you have a relatively stable tax receipt for the IRS. Otherwise, how the hell are you going to finance all this? Are you going to blow Treasury capital raise through the roof? And instead of $4 trillion by 2025, it'll be 5, 6, 7, 8 trillion. The world's not going to be able to finance these countless trillions of dollars, and that's going to go around the Fed balance sheet, and that's just to blow disparity through the roof. Because when the Fed monetizes these instruments, it increases domestic liquidity conditions, as we inspect here on this famous Arthur Hayes chart, and as that disparity grows stronger and stronger, and more people enter the relatively wealthy amount of capital that they have because they own assets, the vast majority are always left behind, and they're in a constant disadvantage. Working for a salary, you get nowhere. 3-5% raises per year, it just doesn't work. So you have social unrest. As disparity increases, you have social unrest. You have the persons that are left behind constantly seeing the Porsches and the Ferraris driving down the street, and that causes all the emotional response that one could easily come to the conclusion occurs when you see that and you have no opportunity to climb the ladder, growth of your career, growth of your status economically. And I think this is all the stuff they're thinking about. They are extremely smart, and they have countless economists at the Fed. All the Fed offices and regions and banks, or whatever the hell you want to define it as, the Fed organization. And, we'll see how they play their cards. But in the end, I like what Raul talks about, where productivity needs to blow through the roof. How are you going to finance all of these things? And it's going to be a very interesting next couple of years. The whole question, the whole destination for liquidity conditions domestically in the U.S., which is much more potent in financial markets as compared to the rest of the world. The rest of the world, as liquidity conditions improve, you have support, and that prevents excessive depreciations, which is exactly what we've seen in the major U.S. indices. But as domestic U.S. liquidity conditions blow through the roof over the coming years, that's like rocket fuel, and indices and just assets in general are exposed to significantly more liquidity availability, and therefore price action moves accordingly. So the whole question in the short term reduces to whether you have a significant contraction in credit and you have a swath of bankruptcies and capital destruction, which drives up liquidity and forced selling, and is there a lag in intervention? In '08, it took quite a long time, relatively speaking, for the intervention to accommodate the capital destruction that occurred. In 2020, it took not much time at all. They intervened very quickly, and it took like a month or so, 2 months, give or take, and we had just a remarkable V-shaped recovery. But they blew the fiscal cannon very quickly. So probably my expectation is just like they tipped their hand. It's this shit is poker, yo. So with the banking insolvencies of late, the bank went insolvent on a Friday and they resolved it by Sunday. So I think they're understanding that their policy must be not proactive intervention, but rapid reactive intervention, such that they avoid the capital destruction process in an ever increasing, ever decreasing amount of time. So that's why you must be in two camps right now. You must have a portion of your mentality ready for not significant depreciation. You see a mass swath of insolvencies that historically would have sent markets into a panic of liquidation, expecting a massive force selling. But we've seen so many tips of the hand of intervention. So you have to have a portion of your mind ready for rapid intervention, which means you are forced to maintain exposure to the markets under all circumstances. Now, that we also must have the risk management perspective such that there can be some legs to a rapid depreciation, a rapid force selling and liquidation process, which presents opportunity. If the U.S. government is going to remain fiscally solvent, where they have their tax receipts that they absolutely require to maintain the whole function of the system, the intervention will come, and the question is how fast, and logic dictates it will occur faster and faster. So you may have an opportunity to acquire productive assets at a discount. I don't expect it to be a very long period of time between 2020's response and what we've seen with the banks. It's going to be a very short-lived opportunity if it occurs at all. So, this is a very unique period of time where you're forced to maintain exposure to assets. It is quite different this time. There's no 3, 5 years of absolute deflation and the system going into an insane recession, 10%, 15% unemployment, and it's 20, 30% contraction in GDP. No, it doesn't work like that. The system, there would be anarchy and chaos, and the whole role of government is to finance social order and civility. The system is not in a position to handle that kind of financial movement with this generation, this population, the mentality of current politics and social topics. So it's just very obvious the capacity we have to reduce the options and choices that we can make regarding decisions of what to do. And that's my role. That's what I've excelled at over my life is reductionism. 4,000 assets in the crypto markets. How many equities are there? All these narratives, the energy equation, green energy, alternative energy. I've explored all of these topics, including augmented reality and virtual reality, and what do we have from an investment opportunity? You might get very excited about what Apple's going to launch today, and I'm very excited as well. But do you think the investment opportunity is with the most highly priced equity on the planet that just breached all-time highs? That's going to turn $100 into $1 million? You are not early to get from the lower tiers of economic status and climb the ladder into the wealthier tiers. You're not doing that on a 2x, doubling your money. And Apple's not going to double. You're not going to turn $10,000 into $20,000 with Apple, with their market cap the way it is. So that's clearly not the investment of choice, even though the narrative is quite exciting. So the process that I offer with regard to reductionism is that, sure, you can have a great narrative. It's wonderful. It's exciting. I use ChatGPT every day for my professional career. It's not investable. Who bought the significant share of ChatGPT? Microsoft. What was it, 49%? Were you going to get a 10x, a 100x on Microsoft? No, you're not. It's not investable. There is so much greater opportunity. Therefore, I find they are investable, but there is a monumental amount of opportunity cost associated with those types of investments. So therefore, we can reduce the options and choices we have of where interesting investments may be. We simplify the equation, and that allows us to make better decisions. And always remember, position size means everything, especially how effective it is in reducing all the considerations we have in how we manage capital. If you can't acquire an adequate position size of an interesting asset representative of an interesting narrative, you are forced to invalidate the position because you won't be able to capitalize on it to a meaningful degree. In fact, you have a great narrative, you have a great asset, it's at a good price point. If you can't acquire a great position size, guess what? You have opportunity cost. It has ticks all the marks, checks every box, and just because you don't have enough money, you don't have enough capital to acquire an adequate position size, unfortunately, it's opportunity cost. And it's too expensive from an opportunity cost perspective. You'll be missing out on an other opportunity that you have potentially an adequate amount of capital available to acquire an effective position size. Smaller portfolios have less opportunity and must concentrate their capital much more than a larger portfolio that has a capacity to diversify to a degree. This is a historic narrative we talked about with regard to don't go all in, don't spread too thin. And depending on the size of a portfolio, you have a different range of calibration that you could do with regard to diversification versus concentration. Very important to really hone in on these concepts, especially in this market right now. I would argue more so than ever, I see great opportunity for concentration. Um, there's not many very large scale narratives in the entire crypto space. Go figure. Go figure. You have great narratives and a great diversification of protocols attaching to narratives, but lindiness indicates that the smaller protocols have no capacity to disrupt the incumbents because that's the natural flow of systems, and all systems reduce to all abstract systems, these financial systems, reduced to very natural biological systems, and the strongest predator, the strongest protocol. You just don't have a disruption of that. It doesn't occur. Apple has never disrupted Microsoft in business ever, no matter how big Apple grows. They have no capacity to disrupt that historic trend, that historic lindiness that Microsoft has with enterprise business. Interesting stuff. 26 people in the stream. I appreciate all of you. 6 likes. Hit that thumbs up button. Hallucians in the house. Tapsy, Dan, Shisha, Paul, Crypto. Could you speak to the tokenomics of Tapioca and OTAP? I find it a bit confusing. Generally speaking, you have a seamless cross-chain stablecoin, and that can be minted with varying forms of collateral, predominantly Ethereum. I don't know the governance process with regard to accepting new types of collateral, but generally speaking, that is the market it hits. It's going to be a very interesting launch, particularly because there's a lot of incumbents in the space. It offers something novel, albeit USDC has a capacity for chains to extend its cross-chain compatibility to a greater degree. Right now, I think it's just Avalanche that you could just literally swap instantaneously from Ethereum mainnet to Avalanche. I saw that on Wormhole the other day that I was using it. But then again, USDC has its roots with collateral existing in traditional finance. So there is a risk profile associated with that. What's going to be an explosion in the crypto markets is LSD collateralized dollar liabilities. And how it plays out, you never know. But the technology that they're building is very interesting to facilitate the seamless cross-chain interoperability and liquidity provisioning, which was a tweet that I had as a locked tweet for a long time, my 2021 narratives, and that really is very fulfilled by Tapioca, and that's a big deal. To the extent that it's a big deal with regard to financial opportunity, you only know how well something does in hindsight. But technologically speaking, what they are going to, unleash functionally is of systemic importance. These Stargate, well, these layer zero standard cross-chain tokens is quite profound. When you could interact with any protocol on any blockchain seamlessly and not know what blockchain you're operating on, then you're hitting critical mass with regard to the destination for crypto markets, especially as it pertains to being consumable by the general public. General public, it's a very interesting perspective. Most folks that listen to me have been in this market for a long time, but we've seen a great glimpse of our peers, of the general public and their behavior, and we could safely state that the general public interacts with crypto predominantly in centralized exchanges and MetaMask, pure MetaMask, and Uniswap, and not even only Uniswap. The vast majority of their interaction is with the MetaMask swap functionality. So that is the final frontier. That is the majority perspective. The majority do not interact with these protocols. They do not interact with Stargate and bridge over to Arbitrum and offer LP positions. They don't even offer LP positions to Uniswap. They literally just know MetaMask, Swap, and maybe Uniswap. And that's it. So that's the place where Tapioca is likely a big deal, to allow seamless cross-chain transactions vis-a-vis protocols like Stargate, and you just do a trade and it sources liquidity from all chains, and you get your purchased assets back on the chain where you made the transaction from, and you won't even know that you're interacting with 20 chains, 5 chains, whatever it may be. So that's a very interesting narrative. Um, I look forward to their balancer, their bootstrapping. I don't think that that I got to keep my eyes on when that is to occur. Um, but that we must fit that into the equation of where we are in liquidity conditions and macro financial, the setup. So that's always a complexity. When you see opportunity, something that's interesting, something that ticks all the boxes, yet you have dark clouds in the horizon that present almost undigestible complexities in where things and what things will occur in the short to midterm. The long term is very obvious. The long term is clear as day, and we started the whole stream talking about the long term. And the whole question we have, especially as the TGA capital raise plays out over the next weeks and months, is what happens in the short to midterm. And short to midterm really is end of fiscal year 2023. See what happens for the rest of the year. I mean, look, we're staring at a weekly chart of domestic liquidity. I stare at the monthly chart on the move indicator, and on the DXY, I stare at the 6-month chart. So it's like, actually, this is pretty interesting heading into summer with 25 days remaining on the DXY 6-month chart. So if the DXY, I'm totally like bringing it back to macro for a second. If the DXY closes below the start of last 6 months candle at about 103,499, and I think we could, we're moving like 2 points on this chart with relative ease lately. That would be one hell of a close. Anything below the open of the previous month's candle is confluence suggesting continuation with the prevailing directionality. And the prevailing directionality is the most monumental shooting star on this chart ever. Even in 85. It is the biggest shooting star on the 6-month chart since 1985, which indicates directionality reversal. Now, that's why we wait. We have to wait for confluence, and you have to wait for the follow-up candle. And I'm tired of waiting for, you don't wait for 4-hour, you don't wait for daily, you don't wait for weekly. You're going to drive yourself nuts trying to figure out the directionality of things. I'm all the way up to the damn 6-month candle at this point. So I will be changing my story significantly if we see a close on the DXY below 103.5 in 25 days, 8 hours. That would be an extraordinary candle body close following this monumental shooting star. Um, Hope that helps, Paul. In the end, we have to wait for it to launch. We've seen it in its production beta uh, capacity, and that seamlessness is quite extraordinary when you're swapping things cross chain. It's just like boom, 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 boom. So the layer zero, um, you know, token standard is quite interesting, and I look forward to tokenomics with the OTAP emissions, and which is the options that we've seen most recently do quite well with Bunny. And we'll have to see the whole dynamic on how the market accepts it, how the market is interested in it. It's clearly a very technologically sophisticated protocol, and the market doesn't respond extremely well to the technically sophisticated protocols. Look how the market responds to like Ben and PSYOP and whatever garbage is um, being used as a capital raise, as an investment contract by these folks that are capitalizing on the general public's interest in investing, but they don't. The general public doesn't have a capacity to have these complex narratives. As I said, the general public has a capacity to barely use Uniswap and the swap function in Uniswap, and maybe some Uniswap, the swap function in MetaMask, and maybe some Uniswap. So that's a very different mentality for a user group as compared to us, or the technically sophisticated market actors that are like, oh, cross chain. I'm bridging my capital cross chain. I'm taking advantage of the opportunity over here. I got to bridge my capital back. There's different risk profiles associated with different chains. That's a very sophisticated narrative as compared to the average market actor's narrative. Shisha, can you assess the impact of the end of interest rate hikes on financial market sentiment, considering the interplay between investor behavior, risk appetite, and market valuations? Well put. So historically, the end of interest rate hikes is in response to some sort of systemic event that's going on. And that's why historically, when you see the charts posted on social media, the turn in interest rate hikes is very tightly correlated to a significant downturn in equity prices. Like you'll see things starting to fall off a cliff, and then that's where Fed policy is trying to accommodate the the forced selling that is occurring in markets by increasing liquidity conditions by well indirectly by reducing interest rates that increases the potential for market actors to take on credit, which increases circulating currency, which increases liquidity conditions, and over time takes the pressure off forced selling to acquire liquidity. Historically, that takes a fair amount of time. But these are uncharted waters. The resonance is occurring faster and faster to the degree that they were forced to intervene in banking collapse over a weekend. It's different this time, and it's not risk off and risk on. There is a whole gray area of uncharted territory of we've already seen it. Look at the market, where it is. The behaviors of market actors have changed significantly over the last couple of years. We're talking over the last 1, 2, 3 years. And everyone points to like history. History rhymes, it doesn't repeat. It'll rhyme, but I think we're going to be quite surprised how how it rhymes the next time with history, but it's like, oh, that's very different. We're going to say the rhyme is like significantly different as compared to anything that's historically comparable. We've entered perverted financial system territory where we have a significant divergence between the upper class and the working class, where asset prices blow through the roof as they're tied to systemic liquidity conditions, as liquidity is used to artificially prevent mass swaths of bankruptcies, which is capital destruction, which has the negative impact on tax receipts because they cannot afford tax receipts to drop. they must finance tax receipt stability. And the only way they know how to do that is really to prevent bankruptcy by injecting artificial liquidity so that the bankruptcies don't occur. And then the only real solution is what Raul talks about, where they have to, instead of artificially inject the liquidity to prevent bankruptcy, they have to finance productivity. And that's how they're able to get ahead of the debt servicing burden by significantly increasing tax receipts, at least nominally, and probably not even inflation adjusted for that matter. They really need to juice productivity and get those tax receipts up. And how do you do that without, uh, you know, increasing consumer price inflation? So you cannot significantly increase liquidity as spendable by the general public, because that just blows consumer price inflation through the roof. So they need to be, that's where they need to be most careful with. They really, history has shown us that they don't really need to be that careful with uh, cu- currency inflation. They've significantly increased the amount of currency units in circulation, but the general public doesn't have access to currency inflation. They don't see it. They're not exposed to it financially. They're exposed to consumer price inflation. So as long as the dollars don't enter circulation by significant wage increases, the consumer price inflation remains relatively low. And there's the disparity, because the asset holders are exposed to currency inflation. That's something we talk about a lot, assets being protective of currency inflation, but unless an asset is productive and it has cash flow in the form of an enterprise, it doesn't protect against consumer price inflation. And that's why we talk about enterprise so much. Hope that helps. John, love your stream. What's your outlook for CRV, CVX? Seems like a lot of protocols are starting to build on top of the Curve USD narrative. Do you think it'll make a comeback? Oh my God, the amount of protocols that are building on top of CRV USD, the amount of protocols that are spinning up of further liquid staking derivatives. I think I've seen 3 that are pretty close to launch. And I expect that to just be rapid fire at some point. You're going to see, it's like CVX CRV, Staked Out's version, Yearn's version, Curvance, concentrator. There's boom, 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 boom. You can see new protocol after new protocol jumping into the federation, trying to capitalize on this group of protocols, this organization of protocols that is contributing so much significance to the way financing occurs in the crypto markets. Curve isn't they're very innovative with their swapping algorithm, extraordinarily innovative, and their new V2 new improvement to their Tri Crypto Factory is extraordinary. But I think still that's marginal compared to what they created with their monetary policy. Um, and it's what's so fascinating. What's so fascinating about the current monetary policy is that it's simple. It's the original implementation of voter escrow. They created this whole thing of where emissions have governance rights, and it creates currency recycling where you want to buy it. You don't want to just sell what's given to you because you have a capacity to participate in the whole capital flow of the protocol. And that's what fascinates me so much about Curve, because of all the derivatives, all the federation participants that have joined in to suck circulating supply out of the market. And that is exactly what we've seen with sovereign bond sterilization since 1971. Where the rest of the world has financed or has given the U.S. a capacity to run significant fiscal deficits, and the rest of the world just finances it and buys it and keeps the bond market liquid, the most liquid market in the world, and that we're seeing play out. Every time you see a derivative protocol come online that wraps CRV, that is akin to another nation starting to accumulate U.S. government securities and sterilize them. These protocols are sterilizing excess curve in circulation such that you have a relatively inflationary protocol, but that inflation isn't entering the supply of the general public. It's fascinating when you compare what's occurring in the crypto markets to that of the real world financial system, and you see all these comparisons, and the analogy is there, and it's quite eye-opening and fascinating. It's not just the comeback. Curve is rallying, it's triumphant, it's winning every time you see a derivative come online. This price action is downright extraordinary. The price point it's at is incredible. It's not down. That's what you say in a bear market, especially for a protocol that's emitting freshly minted currency units on a weekly basis to the degree that they are. They are printing currency units. And the price isn't down. That tells everything about really why isn't it down? And that's the story that's so fascinating. To top it all off, this is an Adam and Eve pattern, and the Eve is an inverse head and shoulders. So when we see increased liquidity conditions and we return to a positive sum game, this is a fascinating uh, uh, this will be fascinating price action. But the hardest thing about the narrative that I tell folks about how excited I am for the federation that has built around this protocol is you shouldn't be expecting significant price appreciation. Um, while I think that'll occur, you're not going to get the 100x, 1000x, 10,000x. It'll be fascinating when this thing is at $5. It'll be fascinating when this thing's at $20. And that's not the asymmetric, ridiculous appreciation that folks are expecting with their bullshit meme tokens. But those will be extraordinary numbers considering what it does from a financing perspective and what it does as a protocol as compared to what sovereign nations do, well, how they finance domestic fiscal policy by using government debt as a means of capital raise, which is basically using tax receipts to incentivize a capital raise and taking future money and bringing it into the present. Anyway, I don't want to go too far down that rabbit hole, but I find this chart absolutely fantastic from every measure, everything that I look at from traditional financial markets to the broader crypto space. I'm even more enticed by this chart. And that doesn't mean to me I'm acquiring any more. I, and if there's a significant price depreciation, that may be an opportunity. But what, 30, 40 cents? Maybe you could get a ridiculous clip, and you see a incredible swath of forced selling. Where's the forced sellers going to come from? Wouldn't they have already exited their position if it was a meme token? The story here, I think, is going to be quite interesting when we look back in hindsight. Shisha, what do you need to happen to add to your curve position? I was talking to my wife about this. We were talking about compounding last night, and I've said to her, I don't think there's anything that could get me to add to my curve position right now. I have the position size I want. I have the position size I likely need for where the market will be in the next 5 to 10 years. Now, if I added more, I'd be just increasing concentration, which is usually a good thing. Buffett historically said that if he just bought insurance companies, he would have done significantly better. And that's incredible for the amount of money that he has and his Berkshire Hathaway has. So that is a consideration that you just concentrate. You buy the winner, you add to the winner and sell the losers, unlike what the average market actor does is, if something's up, you trim profits and you redistribute the things that you think have yet to appreciate. That's not what you do. You sell the losers and buy the winners. So in this instance, I think that's the case. But there's other ferociously interesting narratives in the crypto markets. And to top it all off, I don't necessarily want to invest right now, which means weekly revenue is taken as cash flow and you have it as liquid capital, which means you could use it to finance living expenses. And what do you do with income? A certain amount of dollars automatically allocates to a 401k if you're thinking from like a traditional employee standpoint. Oh my God, my bandwidth. Oh, bandwidth's all over the place. I hope the bandwidth keeps up, guys. Um, So I don't want to invest everything at this point, and in fact, I'm not really investing much at all unless I see a ridiculous, like hostile takeover opportunity to the tune of how Warren Buffett would think of something. If there's a ridiculous discount on something, then this is a time in markets where you're like, either it is a screaming opportunity, or I don't really want to take risks, and um, and that's okay. I am not I am not the dollar cost averager necessarily, but I think my wife will get me to allocate some capital. Albeit, what, last week I mentioned I did take the Eth clip, and so there's that. That is an investment. Um, so I don't know. It's not easy to make choices of when to enter. I've said to you guys the hardest part of managing capital is entering a position. Once you have a position and you have a directionality that you see that position taking over the next 5 to 10 years, that's great. You have a position, and hopefully that position is producing cash flow of which you can make decisions about what's going on. And and the hardest part is allocating that capital and then letting the market does what it does based on macro directionality. Um, Huge BTC dump live right now. I got to check out the charts. I'm really looking forward to what Apple's coming out with today as well. Shinzo are these projects that create stablecoins based on collateral like Ethereum printing money similar to central banks. Not like central banks. They are printing money akin to Eurodollar banks, which is collateralized debt positions, CDPs, where you have a collateral which has equity in it and there's an associated dollar denominated value associated with the assets, and you are creating a dollar liability associated with that value. So not akin to central banks, but akin to credit cards, secured loans, not necessarily personal loans, which are unsecured loans, but like a mortgage, which is a down payment, and a collateralized loan where your house is held and owned by the bank until you pay off your full debt. So the vast majority of money, of currency in the world is not created by central banks. It is created by the private sector, the commercial banking system, and even more so in recent times, the non-banks and how they facilitate credit, the credit creation of dollar liabilities. And does it affect the liquidity situation in the crypto markets positively, or are the amounts too small? So that's very exciting to think about. I see the crypto market as a sovereign nation, but a nation unlike any other sovereign nation, because it is a sovereign nation that's directly accessible by any nation on the planet. To invest in crypto markets, you don't have to go from Shanghai or Singapore to London to the New York Stock Exchange to invest. You're going directly from wherever the hell you are to these markets. This is a globally accessible credit market. Globally accessible credit for you, the people. And that is the long-term narrative that is the biggest narrative in the entire crypto space. And that's dollars. The biggest narrative in the entire crypto space is dollars, dollar liabilities, and the capacity to print dollar liabilities permissionlessly. Because when countries have a credit contraction and companies, enterprise, their backs against the wall and their existence, their survivability is on the line, their behaviors change. And that is the type of market condition that makes me probably the most excited about the crypto markets, because there's no banking, there's no underwriting. This is a permissionless system. If you need dollar liabilities and you have a capacity to acquire collateral, You're going to be able to borrow dollar liabilities no matter what, unquestionably. And then with the liquidity that's available between Circle and Tether, you're able to use those dollar liabilities in the real world to finance outside of the crypto space uh, um, uh, debts. You'll be able to service your capex requirements. And to top it all off, that all puts pressure on Circle and Tether to acquire capital to purchase more of their balance sheet, and their balance sheet predominantly consists of U.S. government debt. So all of that activity, all of this printing of dollar liabilities that we do in the crypto space puts positive buy pressure on U.S. government debt to conform with the balance sheet requirements of Tether and Circle, USDC. And that I find quite fascinating. So this is kind of like really the ultimate solution for U.S. government fiscal deficit spending. Like who's going to buy the treasuries? Circle and Tether vis-a-vis dollar liability printing in the crypto markets permissionlessly globally. So it needs to expand significantly. But if you print $100 billion, you could buy a 50 bill worth of ETH and collateralize it to print 20, $30 billion worth of liabilities using any of these CDP systems. Not any, but you understand the point I'm trying to make. And all of a sudden, there's a $20 billion imbalance between USDC and some stable coin. All of a sudden, Circle or Tether needs to manage the peg. And how do you manage the peg? They're going to have to do a capital raise and significantly increase the amount of collateral on their balance sheet so they could finance the peg stability and make sure their balance sheet is reflective of the amount of their currency units, USDC or Tether respectively, that are in circulation. And that's going to put tremendous buy pressure on U.S. government securities. That's damn fascinating. So it is too small, Shinzo, but the tell is there, the hint is there of the causality of these effects on what it could have and how the crypto markets affect buy pressure on U.S. government securities. Downright fascinating. We'll end on that note, ladies and gentlemen. Globally accessible credit for everyone, and that is changes everything. 26 people remaining in the stream. I appreciate all of you. 13 likes. Hit that thumbs up button. Tell everyone to subscribe so we could help a little bit more. You know the deal. After party on Discord for the most rational community in the entire crypto space. I wish you all a wonderful day. I will see you again the middle of the week on a Wednesday. Peace.